Is Intel a buy or a sell? Let's get started with the model. This is a large cap company, 106 billion market cap. They're trading at $25 a share, and they have 4.3 billion shares outstanding. Intel designs, develops, manufactures, markets, and sells semiconductor chips. It was incorporated in 1968, headquartered in Santa Clara, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. They did have a healthy amount of free cash flow in 2021, over $9 billion. Then after that, big negatives, and the negatives are getting worse. Negative $15 billion in the trailing 12 months. They're investing a lot into CapEx. CapEx is property, plant, and equipment. They're building out more semiconductor manufacturing facilities. They're trying to compete head-on with Taiwan Semiconductor. That's a hard thing to do when you're in the US, because manufacturing in the US is so much more expensive than pretty much any other country, especially an Asian country. Net income is the profit or loss on the income statement. It's revenue minus expenses. Really nice number in 2021, 20 billion, great margins, 25%. Now it's negative 16 billion, lots of write-downs, lots of impairments. Revenue is a sales for the company, and that looks terrible, from 79 billion in 2021 to 54 billion currently. But revenue is flat from 2023 to the trailing 12 months. Maybe in the near future, we'll see some big jumps. They do pay a dividend of 2.25%, which cost them $2.4 billion. Since they have negative free cash flow, that means they need to add debt or dilute shareholders in order to fund the dividend payment. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 240 billion. We discounted those numbers back to today using the weighted average cost of capital. We got a value of the company of $160 billion. We divide that by 4.3 billion shares. And we get a calculated stock price of $38. They're trading at $25, so they're trading at a 35% discount. It's a pretty strong buy according to the model. This stock has gotten beaten down so much, you would think it's a great value at this point. But if it was such a great value, I guess I would buy it. I'm a little concerned. There are 64 companies in the same industry as Intel, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, 25 billion. That's just in the past 12 months. A little more than Taiwan Semi, and Taiwan Semi is 10 times the market cap. Debt to equity ratio is 0.5, a little better than the average. For every dollar of equity, 50 cents of debt. They pay a nice dividend, 2.2%. One of the higher ones on this list. United Micro pays the highest, 6.6%. They're the only company with negative free cash flow, negative 15 billion. They rank 10th in market cap. In the 90s and early 2000s, they were number 1 by far. Price to book is the most attractive. Investors are paying $1 for $1 book value. Price to book is stock price over book value per share. We can't look at that PE, negative earnings. We can't look at that price to free cash flow, negative free cash flow. Price to sales is a little below 2, so investors are paying $1.90 for $1 revenue. They used to have the most revenue for a long time, but recently they got taken over by NVIDIA, and even Taiwan Semi is bigger. Their revenue is going down, the only one on this list to have declining revenue. Their 5-year annual revenue growth rate is negative 5%. Their 52-week low is $19. They're trading pretty close to their 52-week low, so it could be a good time to get it. And their 52-week high is 50. If they get back up to 50, you can get a 100+% return on this stock. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $8,800 today, a 12% loss. To summarize, I have them trading at a 35% discount, ranking 5 out of 10. Would I buy short term? 5 out of 10. Long term, I think it is a good stock, 7 out of 10. It's got to break out sometime. For 20 plus years, it's been struggling, and I don't think they're going to go out of business. Ratio is 3 out of 10. We can't look at that PE or price to free cash flow. Financials look terrible, 2 out of 10. Negative free cash flow, and it's getting worse. Their revenue is still over 50 billion. Even though it was higher in 2021, it's still not that easy to get 50 billion of revenue. That's the only reason I don't give them a 1. With Trump in the White House, will that help or hurt Intel? Let's read this article. Trump bashes CHIPS Act. All you had to do is charge them tariffs. The CHIPS Act was under Biden's administration. The purpose of it was to bring jobs to the US by making it more expensive to import semiconductor chips from other countries, mainly Taiwan. The purpose was trying to encourage companies like Taiwan Semiconductor to manufacture in the US, or for US companies to buy from other US companies instead of buying from overseas companies. Trump said that chip deal is so bad, we put up billions of dollars for rich companies to come and borrow the money and build chip companies here, and they're not going to give us the good companies anyway. The article says it's not clear who the good companies are. The world's second largest chip manufacturer is Taiwan Semi. They're set to receive $11.6 billion in CHIPS Act funding. That's a lot of money you're giving to a Taiwanese company. $6.6 billion in grants and $5 billion in loans. And they're building a major fabrication center in Arizona. US companies like Intel, Global Foundries, those companies are also beneficiaries of the CHIPS Act, as well as other South Korean firms. Trump said all you had to do is charge them tariffs. If you put a tariff on the chips coming in, just like the auto companies, it's no different. Tariffs are like a tax that are paid by the importer, not the exporter. The semiconductor industry claims that tariffs would not cause fabs to be built in the US due to the cost of the factories, which run from $18 billion to $27 billion. It's cheaper to build them overseas. No tariff amount will equal the costs of ripping apart these investments and efficient supply chains that have enabled current US industry leadership. Moreover, chip tariffs will drive away manufacturing in advanced sectors that rely on semiconductor technology, such as aerospace, AI, robotics, next-gen networks, and autonomous vehicles. If the cost of key inputs like semiconductors is too high, tech manufacturers will relocate outside of the US, costing jobs and further eroding US manufacturing and technological competitiveness. Despite a large decline in chip manufacturing market share, the US still exports a large number of chips, with 82% of its sales to overseas companies, making it the nation's fifth largest export. If other countries impose tariffs, that could put exporting at risk. Taiwan and South Korea have taken much of the market share. Those companies have invested heavily in their chip fab sector with generous subsidies. Trump said, Taiwan, they stole our chip business. The US buys 92% of its leading edge chips from Taiwan Semi, meaning any disruption to that supply chain would have a significant impact on the US economy and data center market. Let's take a look at that 1031 presentation slides. Q3 highlights: $13.3 billion of revenue, down 6%, 18% gross margin, down 27.8 points, and EPS negative 48 cents, down 87 cents. This dark blue line is their revenue. It went from $14 billion to $15 billion, down to $13 billion, flat again in Q2, up a little bit in Q3 to $13.3 billion, but still down from Q3 2023. And their margins are getting terrible, 18%. It was almost 50% in Q4 2023. The light blue line is operating income. They had positive operating income in Q3 23, Q4, Q1 2024, break even in Q2, then a loss in Q3. It just looks awful. Here's a breakdown of their cloud computing group. This is data center AI, and next is network and edge. So cloud is their biggest, but that's also down from Q3 2023. Their peak was Q4 2023. But they do have positive operating income in every quarter. Same thing with data center AI, positive each quarter. And network and edge is also positive each quarter. And their margins look really good, almost 18%, their highest ever. Cloud computing is also pretty good at 37%. It was higher than Q3 2023. But on the next slide, you'll see why they have a loss. It's on Foundry, building out their manufacturing facilities. They took a big loss, almost $6 billion, on $4.4 billion of revenue. It was mainly from a big impairment, a $3.1 billion impairment. That's when you write down the value of an asset and pass through the loss onto your income statement. It's a non-cash item. And they're spending so much time on Foundry, yet the revenue is not going up. In 5 quarters, it's down. It was $4.7 billion. It actually went up to $5.2 billion. Now it's down to $4.4 billion. They do say several Foundry wins. Maybe we'll see the impact in the future. It's definitely not at the current or past. Here are 2 companies they own, Altera and Mobileye. Altera had $400 million of revenue, Mobileye $485 million. Both have positive operating income, at least in the most recent quarter. Here's the outlook For Q4, 13.3 to 14.3 billion of revenue, gross margin almost 40%, EPS of 12 cents. I think if they hit this, the stock should do well. Let's take a look at Simply Wall Street. Its last price, 105 billion market cap, up a little in the past week, down 44% in the past year. It looks like the stock started trading in 1990 at $1.23. That's stock split adjusted. It peaked in 2000 during the PC boom and never got that high again. Imagine buying it in 1998, then waiting 26 years, and you're flat. Actually, you're down a little bit. So it hasn't traded in the low 20s for almost a decade. I don't think it's going to get down to single digits, but who thought it would get down to this point? Simply Wall Street's valuation is 148. They say the stock is 84% undervalued. 34 analysts priced this stock at 25, where it's trading at. Revenue back in 2013, 52 billion. Now it's 54 billion. They did get up to 80 billion in 2021, but they've been losing a ton of market share the past few years. They had 14 billion of debt in 2013. It got up to 50 billion, which sounds like a lot, but their equity is always a lot higher than their debt, so they're not doing that bad. And they do have 24 billion of cash, a little less than half their debt. Plenty of cash to service the debt. The CEO has been buying a lot in the past year. One big sell for 25,000 shares. 63% of the company is owned by institutions, 37% by the general public. Their biggest shareholders, BlackRock, then Vanguard, State Street. You got UBS on the list, Norges, the Norwegian bank, Van Eck, B of A, Amundi, Schwab. Lots of big funds. Make America Great Again. 108,000 employees in 2013. It got up to 132,000 in 2022. Now it's down to 125,000. And the ticker trades on the NASDAQ, Lima Bolsa, Mexican Bolsa, the Bern, Deutsche Börse, Hong Kong Stock Exchange, Zicha, Swiss, Santiago, Borsa Italiana, London Stock Exchange, Wiener Börse, Kazakhstan, Bulgaria, Santiago, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. So if you want to learn how to build a discounted cash flow model, I'll show you where to find all the inputs, the revenue, the free cash flow, the WACC, the terminal value growth rate. I'll show you everything, and I'll even send you an Excel file for free. All you have to do is watch this video in the top right corner. Preferably watch it every day for the rest of your life.